All right, so optimal asset allocation and building a portfolio. Now, when we're talking about assets, there are different asset classes, okay? And different asset classes have different risk profiles. So if I'm looking at, let's say, cash, right? It's very low risk, but in return, it has very low return as well. Now, if I have something like a property, real estate, it's riskier. And when I'm talking about risk, it means the value of that can fluctuate more. A house's value will fluctuate more than cash. Cash is just going to stay cash. But it has higher returns. If I have equity like a stock, that's higher risk, higher return. Alternative investments, higher risk, higher return. Now we're investing in cryptocurrencies, which is way out there, right? Very high risk, very high return as well. Again, high return if it goes your way, but there's high risk. It could fluctuate a lot. You can even lose a lot. So this is why it's there. Now within cryptocurrencies, you have different assets as well that have different risk profiles. And this we can literally, draw in a way. So you have different things that have more risk, right? Or less risk, and have more return or less return. Now, these assets could be, and see if I can draw it correctly. It's not necessarily like that, but let's say you can have Bitcoin, which is the one that's going to fluctuate the least, so less risk, but the least return as well. Now, you have other cryptos that are going to be here, which are altcoins. And these altcoins might be in the top 10, so bigger coins. So higher risk, higher fluctuations, but higher returns. Then you might have some other coins that are very small coins, right? That are not in the top 10, but maybe in the top 400. And these ones can fluctuate way more. But if they work, they could generate a lot too. So now you have to select a portfolio that suits your risk appetite. We've already agreed that you want to invest in cryptos. Now, within cryptos, which assets will you invest in, right? Will you invest in something like Bitcoin, right? That fluctuates, but is so big and is so strong compared to other coins, it's going to fluctuate less. Or would you start investing in something else, like in the top 10, that might have bigger returns, but as well, more volatility, right? Than Bitcoin, right? Look at this Bitcoin dark today, up 400%. What is that? Yeah, so the lower you go down this list, okay, the smaller these coins are, the riskier they are, right? The more fluctuations they will have. The further we go down this list in market capitalization, the more that we see the fluctuations are going to be bigger. We're going to have things that move up 70%, things that are down 11%, things that are down 10, and you're going to have things 11, and things that are up 10. And you're going to see things that are down 40% and up 60 and 100%. So more risk, right? Now, what you have to understand is it's not because this is here that this is going to do less good than something here. It's not because you buy Bitcoin that you're going to make less return than if you buy whatever XYZ coin that's rank 500. No, this one might go to zero. You might lose all your money on it. And this one might go up, so you might make more on that. So it's not just because it has a higher risk profile that it'll make more returns. No, it just means it is way more volatile. Okay? You could make a lot more on it. You could lose way more on it. Okay? But it doesn't mean you are going to make or you are going to lose. So that's one thing to think about. So when you are looking at, which assets to select, based on your risk tolerance and how risky you want to be, you have to divide that. Okay? You have to have an allocation between them. example. Okay. And so the definition for optimal asset allocation, it's the process of diversifying your portfolio across several asset classes in order to achieve the best asset mix that optimizes your returns for your given level of risk. Okay, so it's based on you. Now, in equity sector, usually you're going to have a portfolio, and they might say, well, optimal asset allocation for this person is going to be have some bonds, so it's like cash, debt in a way that doesn't fluctuate and gives us safe returns, and then have some equity in, let's say, large caps, so very strong companies, and then have some emerging market equity for investing in other emerging countries, but a smaller percentage. And that might be for somebody who's a bit safe, but wants to take some risk as well. But then you might have another portfolio that has zero bonds, it's all equity, and it's all high risk tech companies in the emerging markets. So that's super high risk. Well, that's the risk appetite for that person. Okay, that portfolio is going to fluctuate way more. Okay, might have way more returns, might have way less than another, based on how the market behaves. So then you're going to have to select your optimal asset allocation. I guess, created a few just to have some examples. I believe something that would be very conservative would be putting a lot of your funds in Bitcoin. So let's say 75% Bitcoins and 25% altcoins. Because altcoins, when the market crashes, they crash a lot, right? So then that's a conservative portfolio. Consider, how conservative can you be when you are in cryptocurrencies? You are taking risks anyways, but within that sector, it is a conservative portfolio then compared to another portfolio. A moderate portfolio, I would say, it would be 50% Bitcoin and 50% altcoins, so divided between both of them. And then something more aggressive would be 25% Bitcoin and 75% altcoins. Now you have way more altcoins. Now it doesn't have to be like that. And we're going to actually add another asset class to this when we talk about active investing. So we're going to add something to it. But for now, even with that, you can have any numbers you want. So I know people who don't have any Bitcoins at all. They only have altcoins, 0 Bitcoins. I don't believe that's correct. I believe you have to have Bitcoin in your portfolio because it's such a big name. And, in this tech sector, we always see huge names, lead the market. And there's always this thing, as a lot of people see Bitcoin as that, that payment and that store of value coin. So it might be that one that succeeds in the end, and other ones for payment and store of value that don't. We don't know. So it's better to have a little bit of risk, a little bit of funds spread out. But you can have it, you can have it that way if that's the way you want to go. Somebody else might say, I just want a Bitcoin. I don't want to risk in any of these other altcoins. Okay. It's really up to you, and you can have the percentage you want. So you can go ahead and say, I want to have 20% Bitcoin and 80% altcoin, or 30% or 40%. I believe you should have some Bitcoins in your portfolio, somewhere, I would say at least 30% of your portfolio, or 40% up to 50 would be good, because it is such a staple, and it has such a big impact, and it adds to the diversity, because sometimes Bitcoin goes up and the other altcoins don't go up. Sometimes the altcoin goes up and Bitcoin doesn't go up. So it's good to have enough of it there as well. And also, again, if you want to have right diversification and not having too much risk within one coin, you have to spread out and choose several coins. Having around 10 coins or even more is recommended, because you're spreading out your risk. If something happens to one of them, it doesn't happen to the others, and then you've diversified away some of that risk. You can maintain the same type of return while reducing your risk. So it's absolutely something that you should do, spread out across several coins. And that should be it for this lecture. I'll see you guys in the next one.